Hello, YouTube. So, for today, we will be discussing and understanding institutional liquidity. So, what is liquidity? So, with liquidity, we can do many things. For instance, taking trades. Why? Because in the markets, we have scenarios like this, for instance, right? Where price here gives you a breaker structure. So, realistically, after price gives you breaker structure, every trader knows that there's always impulse and then it comes back down and tries to mitigate an order block. So for instance, here gave you a break structure, price humidity, what did it do? Go here, mitigated and went up. Now this is the trick where the bankers and institutions, I call it a SMC trap. Why? Because they know that we operate based on breaker structures and order blocks. So what they do is with liquidity, they form a high, another high, and once those two highs are formed, you're thinking us noob traders, retail traders, as they call us. Oh, price is gonna go here, and what does it do? It immediately gives you stop loss. Why? Because what they were doing is with those lows was forming purely liquidity, money injection. So once they left all that money there, all they did was bring price down to where it was actually supposed to go, mitigate and go with the trend. And it's example in these examples as well. Liquidity, pure liquidity here. Price gave you a break structure, left you a low, and what did it leave you with? Liquidity. What did price do? Bring down, took liquidity, snatched it, mitigated the order block, and went with the trend. Because why? Because liquidity in every trend, liquidity is below all the lows and above all the highs. So this is like a game. Everything is high and up, below. So, for instance, here in this example, we also see how price did exactly the same thing. Gave you a break structure. And in fact, this is more tricky because price left you with three lows. So I left you with one, two, and three. So I like to call this a floor of liquidity because it left you a floor. And price tried to, manipulate you because this is what Forex is. Institutions want to manipulate you into losing your money because while we lose, they win. So every retail trader would think, oh, price is gonna go here. What does it do? Boom, gives you stop loss, losing all your money and then reversing back to where you thought price was gonna go, which was actually a bullish trend going up. So what did price do? Took all this liquidity here, one for grabbed it, and then immediately went back to its original trend. Now let's go to the graph and show you more clearly the examples of what is liquidity. All right. So first example, let's see. Let's try to find a scenario. All right, perfect. Right here. So after price gave you a breaker structure here, price gave you a breaker structure. What did it do? Simple. Price left you with this order block here. This is where price would have to go. And what did price leave you here on the way as it was going? Liquidity. Same thing as the examples I was showing you guys. Left you liquidity. In fact, price even gave you another breaker structure, to make you think price is gonna go there, but it didn't. So as a retail trader or us without experience, we would think, oh, price is gonna go here, you know. Look, and it actually did give you a reaction. Sorry, guys. It gave you a reaction here. But what did it do? It gave you a false faith of hope. Boom. Stop loss. Lost all your money. Went to the actual zone. Mitigated. Boom. Went down. Let's try to find another example, guys, in the graph. All right. Think around here should be a perfect. All right. Yeah, this is an example right here. Price. What did price do here? After giving you a breaker structure, right here, price left you with a high and a low. Previous low broken, so we're in a bearish trend. So what did price do? Left you with a this large candle order block. Notice how by a little bit it got mitigated. But what did price leave on its way up? All this trend of liquidity. Because liquidity is formed by many different ways. Could be it can be, a bottom. It can also be, ceiling, liquidity, liquidity. Liquidity can be formed in many ways, guys. So here, this is an example of this scenario right here. Price left you with this ceiling of liquidity. So after I give you this break constructor, what could traders possibly think? Oh well, price is gonna go up here. But guess what? Price always is always gonna have a reaction in those zones, but it's never gonna give you the full reaction. See how it reacted here? Give you a little bit. Boom, broke immediately, mitigated the correct zone, and boom, went down and took the sells. So if you had the concept of liquidity, that would never happen. You would never fall for these institutional traps, as I like to call it. So, guys, thank you so much for watching. If you have any questions, just comment down below, and I'll try to answer you guys. Thank you so much for watching.